and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a hard look at the RBI's latest monetary policy announcement that took the markets by surprise, not for the usual reason that one expects, rate action, but for the dramatic lowering of growth expectations for the current fiscal. And to join me in the discussion are three stalwarts: Ajit Ranade, Chief Economist, Aditya Birla Group; Amol Agarwal, Professor Economics, Ahmedabad University; and Anant Narayan, Professor Economics, SPJ IMR, Mumbai. Welcome to the show, Anant, Ajit and Amol. Before the MPC Monetary Policy Committee meet, there were calls for a 25 to 40 basis points cut. The MPC in fact opted for a 25 basis cut. Since no one could call that excessive, given the slowdown, how do you see it, Ajit, as prudent or unduly cautious, Ajit?
Well, I think this cut was expected, as you said. In fact, in a pre-cut survey, almost I guess something like 38 out of 42 economists who were polled. So they expected a 25 basis point cut. The debate is whether it should have been a bigger cut, especially because the RBI itself is saying that the growth forecast is substantially lower than what it put out earlier. And it's a very large downward revision, almost by a percentage point. So considering that, and the RBI also says that the business conditions now are as bad as they were in 2008 in the wake of the financial crisis, then perhaps a larger cut was warranted to bring it down to 5%, which is a 40 basis point cut. But having said that, I must say that the RBI is trying to leave some room for its accommodative stance to continue, and some room for perhaps one more cut in December after the November data comes out on the second quarter. And we also have to understand that the monetary policy can only do so much. I believe that we are in a situation where we are seeing a large gap in aggregate demand. So there's a demand problem. And to what extent the rate cuts can influence this problem is questionable, because I think there's a diminishing utility, diminishing impact of rate cuts. After some time, the rate cut will not get the kind of stimulus you want in the economy, especially on investment spending. So maybe that's why they kept it at 25 with some room.
Anand, do you think the MPC is keeping its powder dry? Because in the press conference, the governor said that he would not really want to specify what could be a lower bound. Anand?
Well, Mythili, I think left to himself, Governor Das would have probably wanted a deeper rate cut. In fact, until 19th of September, I was reasonably convinced after the 5% print that we saw in the first quarter that we'll really see a deep rate cut, maybe even a 50 basis point rate cut. I think what changed was probably 20th September and the large corporate tax cut rate which was announced by the finance minister. Now, one word which is conspicuous by its absence in the monetary policy statement is fiscal balance. There is absolutely no mention of fiscal deficit at all. But I do think in the MPC deliberations itself, it would have figured in, particularly with maybe one or two independent members raising the questions about what the fiscal outlook really looks like and what that means for monetary policy going forward. So I think if there was anything which constrained a deeper rate cut at this point in time, it was possibly the elephant in the room of where the fiscal is going to lead us to. They compensated for a lack of a deeper rate cut, of course, by sounding extremely dovish. And I think the addition of the statement that as long as growth doesn't come back, they will be accommodative was extremely dovish. So they were constrained, but they tried to make it up with some dovish commentary.
Amol, let me just refer you to what Anand just said, that the RBI actually had stopped giving forward guidance. But in the monetary policy statement, there is a statement to the effect that the stance will remain accommodative as long as it is necessary to revive growth. Now, will that come back to haunt the governor? Because one really doesn't know when that growth revival will happen. And he did also, of course, add that as this will continue as long as inflation remains within the target. But can we be sure that inflation will remain within the target if we continue with this kind of monetary easing? Amol?
Yeah, so I mean, I think it was maybe like some reporters said, some analysts said it's Governor Shaktikanta Das's Governor Draghi's moment, where Governor Draghi in European policy, European central bank policy said nearly the similar statement to safeguard euro and European economy. And I mean, as a central banker, as Ajit also said, it's kind of getting very difficult. I mean, how much can a central bank do? And it's like this, that if you don't do, then you're doomed. If you do, you're doomed. So either way you're going to be criticized. So I think a central bank has to back its conviction and its statement. Yeah, so I think it's a tough job.
Yeah, tough job, and sometimes you have to bat blind also. But Ajit, were you surprised by the extent of the GDP reduction, or were you really expecting it, Ajit?
The high frequency data which we get on a monthly basis or even more frequently was clearly indicating that the slowdown. So it was kind of significant that the governor himself apparently made a statement earlier that the growth rate of 5% was quite a surprise for him, which meant that the RBI itself didn't anticipate, and this is reflected in their statement in the policy review as well. So I think if you look at high frequency indicators from various sectors, and also you look at the financial flows. If you look at the net delta in the incremental financial flows going into corporate sector, and then you look at the capacity utilization numbers, which have fallen to 73%, and then you look at the CMI data on capex, all of it was pointing to a slowdown. In fact, I fear that even the second quarter number for GDP growth, which will be announced on November 30th, will also be closer to 5%, if not actually below. So, we are looking at really for this whole year, it will be a big challenge to reach 6.5% or 6.2% that the RBI expects. So in that sense, it wasn't, I would say there were a lot of indicators flashing a slowdown. So it's the RBI has of course confirmed it, and they have also pointed out, as I said, the business conditions index, which is a comprehensive index which they construct, is actually as bad as in 2008.
Okay.
So even the RBI has flagged this now.
Anand, Q2 has been projected at 5.3%. This is higher than the Q1 number. Is that realistic, given that the signs of a slowdown continue and it might be even deeper? So is 5.3 for Q2 realistic?
Well, Mythili, I think what was not realistic was the earlier estimate given by RBI of 6.9% for the full year. If you recollect, at that point in time, practically every analyst had pegged the GDP number lower. 6.5, 6.3, those kind of numbers. What they have done now is bring the numbers down to a more realistic level. 6.1 is a sharp correction down, 0.8%. I can't recollect the last time they brought down growth estimates by 0.8% over one policy cycle. It is a sharp correction. Could it be even lower than that? It could. But to be fair, I think a lot depends upon how the policy response is from here. And I don't mean monetary policy, I mean the overall fiscal and the government policy prospects. If we do get the right set of policy pronouncements and action and reforms, it is possible to see a revival in Q3, Q4. We need the investment cycle to come back. Ajit made the right point about demand having really slumped. I think more than demand, it's the requirement for investment cycle, paradoxically. In India, we tend to consume when we see investments are going around us. At the moment, though, there are lots of constraints, whether it's the trust deficit in the financial sector, whether it's lots of issues in specific sectors like power and telecom and so on and so forth, or whether it's the fact that manufacturing and exports is not really filling the breach and drawing in, let's say, the supply chains from China. If we get some of these corrected, I think growth can pick up both from investments as well as from demand.
Okay, so it's nice to hear some optimism in the midst of all this gloom and doom. But Amol, actually the monetary policy report that was released along with the statement is actually much more downbeat. It says that the near-term outlook is fraught with risks. So should we really have some kind of a voting also on GDP projections? Because here the assumption is that everybody agrees to 6.1. But if you look at the RBI's own MPR, it seems a little bit more downbeat. Amol?
Yeah, so I think just adding on to what Ajit and Anand said, even the professional survey, that professional forecaster survey pegs the growth at about 6.2. So I think they've kind of, as Anand said, they've kind of brought the growth rates in levels. And I really don't know, because as far as MPC members voting on GDP growth rates, that doesn't really happen globally. Most MPC, kind of review the overall situation, and the members basically vote on their forecast, their judgment and the interest rates.
Ajit, you work with a large corporate house. So now with this cut in the repo rates, the real rate of interest is down to a little over 1%. Now, shouldn't that be good enough for corporates to start investing? Assuming, of course, that there is no other deterrent. So will we see investment and demand pick up, Ajit?
Well, actually, as far as our group is concerned, there are significant investments going on in the pipeline. So but I don't want to dwell on being a spokesperson for my group. But overall, if you look at the economy, you look at the capex data put out by CMI, which shows new capex announcements. It is down at a 15-year low. So that is definitely, and what is kind of contributing to that, I believe, first of all, a lot of corporates are still in the deleveraging mode, including very large corporates. So they have actually started, they're still in the deleveraging mode, which means they're not taking on new loans, but in fact repaying old loans. There is also what I mentioned, the capacity utilization number. Across industry, the comprehensive number is at 73%. Actually, you start new investments only around above 75, 76, if not closer to 80. So there is that. There is a large negative output gap. And of course, I think Anant referred to it. We need to look at the overall policy in the sense that in terms of especially the small, medium enterprises, are they finding it easy to access financing? Are they finding it easy to get risk capital? Are they finding it easy to set up new businesses? I'm talking about ease of doing business. So maybe, it's a combination of all this. And then, of course, there's the confidence. Remember that even globally, there's a lot of nervousness among investors. So it's not as if this is happening only in India. But India being a largely domestically driven economy, there is hope that you can actually have significant investment activity happening in India, irrespective of what's happens in the rest of the world. So, for example, sectors like real estate, construction, infrastructure, which is of course largely the government's domain, these can get a big push, I think.
Okay.
But we'll need a coordination of several things happening together.
Okay, so there are some straws that we can clutch, but I'm afraid it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three stalwarts, all A's, Amol, Anand and Ajit, to discuss the RBI's latest monetary policy and see, does it really have the answers that we're looking for? Anand, we talked about the limits to monetary policy. Ajit in particular was referring to it. So is it time we accepted that there are these limits and monetary policy actually is more effective in tackling inflation than in stimulating growth? Anand?
Oh, absolutely, and I completely agree with what Ajit said. I think, look, we've had this debate before, Mythili, about how much of the issues in front of us are cyclical and how much of it is structural. Of course, there is a cyclical component to growth. The fact that maybe automobiles has a cyclical component, maybe even real estate has a cyclical component. But I think most of us will agree that there is an overwhelming level of structural issues which need to be addressed before we can get a private sector capex and an investment cycle back again. We're far away from an investment cycle, by the way, and I think that is really our bane. We need investments, which is paradoxical given the fact that our capacity utilization is quite low. And I think I agree with what you said, Mythili. We eventually can draw in investments because we are an underemployed country. We do have a lot of scope for increasing our own per capita income and our consumption. And therefore, we can foster investments and demand as a virtuous cycle. But to get that virtuous cycle coming through, we need a lot of structural reform. We need a reform of our bank and our non-bank financial companies and our housing finance companies. They are not in a position right now to finance the next wave of investments. As I mentioned earlier, lots of sectors are crying out for structural reform. Power, real estate, construction, telecom, airline and shipping, I can go on. Finally, the ease of doing business that Ajit referred to. Reality is, even if, by the way, there is a lot of goodwill for India as far as an investment destination is concerned. People are really enthused about the fact that we have a growing population, we are a young population, and we should be the next investment destination for manufacturing. Yet the real ease of doing business on the ground still has a long, long way to go. Only limiting ourselves to a monetary or a fiscal stimulus is like giving a painkiller or a palliative to what is a far more insidious disease which needs urgent attention.
Very true, Anand, except that sometimes one needs a painkiller also, especially when the economy is in such severe pain. So perhaps one needs a combination of both. But Amol, in fact, cutting interest rates is based on the belief that if loans are sufficiently cheap, there will be takers. That may be so, but while cheaper credit may create demand, it does not necessarily translate into credit-worthy demand, in which case a few years down the line, we'll again be saddled with NPAs. Is that not a very real danger, Amol?
Yeah, it is. I mean, we are already, sitting at a pretty big NPA problem, and it was pretty interesting how many of you raised concerns about the cooperative bank failure, and things about having an asset quality review for both the NBFCs and cooperative banks the moment it's done, I'm sure the NPA picture is going to be even more stark. So yeah, we need, as Anand said, several reforms, banking, NBFC, and there are already, even Ajit has said that we're sitting with several of these companies. There's a global sort of uncertainty. So during this time, by simply cheapening credit and allowing loans to sort of go to sectors might not really work out. Banks are fairly wary of giving loans to all kinds of places. There is a lot of concern on that front.
But as was to be expected, the governor reaffirmed faith in the fiscal numbers. It's only to be expected. After all, he cannot hardly dispute them officially. But if those prove way off the mark, then when we have fallen the trap of seeing both fiscal and monetary policy easing and risk a repeat of what we saw after the Lehman aftermath?
Well, the government is still confident of meeting its fiscal targets, but the CAG report, especially for 2017-18, said the actual fiscal deficit was 5.8 or 5.9%. So maybe the actual number is also higher, which but basically I think India's demography and savings rate actually supports higher fiscal deficit target. As you know, this fiscal deficit target of 3%, some magic number, was just basically picked out of the Maastricht Treaty of Europe. And European conditions may not be applicable or relevant for the India's, especially its state of development. So I think on the fiscal side, I feel that, as I said earlier, since we have a large problem of aggregate demand, inadequate aggregate demand, this is the time when we perhaps should not be hung up on this 3%. And incidentally, ever since we passed the fiscal responsibility legislation, I guess 20 years ago, we have never met the target, not even close, maybe perhaps once. So why just give up the ghost? We've never, every year we say we put it on pause, or we say we postpone it. So why not just accept that for our country, maybe 3.5 or 3.8% is the right number. In any case, as I said, this year, we need a large stimulus to aggregate demand. And let me emphasize, let's not forget rural demand. Actually, the large stimulus that we need is in rural demand. So for example, consider deregulating agricultural exports, consider moving NREGA programs more aggressively, consider large-scale agricultural reform. Anand referred to power sector, banking, NBFC, but let's not forget agriculture, and let's not forget other services sectors like tourism. So this is the focus, I think, for this year.
I would agree with you, Ajit, and in fact, I think even if the fiscal deficit were higher, I think there is really no harm as long as the rate of growth is far higher than the rate of interest, real rate of interest. But Anand, you've always been championing the cause of fiscal, I would say, conservatism, and you're quite a fiscal zealot, if I may call you that. But at this particular juncture, is it not better that the government starts spending, but on the right kind of spending, on infrastructure, because the fiscal multipliers are better than monetary multipliers? What do you think, Anand?
Thanks for those epithets, Mythili. Look, first off, before we start discussing the fisc, I'd love to know what the real numbers are. We pretend that we've met 3.4% for the last fiscal year. I think pretty much every analyst on the street disbelieves that number, given the fact that we have large off-balance sheet borrowings, given the fact that the government is not making all its due payments to Food Corporation of India and to many other public sector enterprises, and is therefore in many ways doing an accounting smokescreen to hide the real fiscal deficit. It's a bit like the NPAs of on the NBFCs. We don't know what the real truth is. All we know is that the number given to us is not right. So the starting point, therefore, is while we talk about, we are too hung up on fiscal targets, we don't even know where we are on the fisc. And that's, to me, not a good spot to be in. We have to know what the impact of fiscal policy can be. The second part is, I'm all for what you said. If you're actually borrowing money to spend it on investments into infrastructure, into education, into agriculture, like Ajit said, into water management, I'm all for it, because it will eventually play out well. We saw what, for instance, the golden quadrilateral and building of roads did to the economy. I'm all for it. We are not doing that. If you look at the nature of our fisc and whatever numbers are coming out in the CGA website, it looks like all the excess fiscal deficit which is being suppressed is going into revenue expenditure. So we are not really investing for the future. We are actually borrowing off our children. Now, what I find dangerous, a little bit scary, look, no monetary policy committee has ever questioned the government on its fiscal math. So we have to be fair. You have to accept whatever the government says. That's the mandate. But in the past, including in December last year, when there were concerns about meeting of fiscal targets, the MPC does refer obliquely to say that, listen, if we don't meet fiscal deficit targets, there could be a risk for the entire ecosystem. In this monetary policy statement, as I mentioned earlier, there is no mention of the word fiscal anywhere. So if you're not even cognizant of the risk, we've seen in the past what a profligate fiscal policy along with monetary loosening as well as monetization of the deficit can do to the ecosystem. I'm not saying it's going to happen right now, but we should at least be cognizant of the risks and have some analysis around it.
Sure, but I'm sure the MPC did discuss it, but maybe they didn't put it out so explicitly because it's a little difficult to kind of question the government. And no offense meant, Anand, when I called you a fiscal zealot, a lot of people would say, thank God we have some people who keep a careful eye on the fiscal deficit. But Amol, I want to move now to the RBI's issue on external benchmarks for loan pricing. Will the RBI's inability or unwillingness to think through the consequences of their desire to see transmission of policy signals land us in bigger problems down the line? Because as PSPs, in particular public sector banks, see their net interest margin shrink, then it will lead to either lower profits or sometime down the line we'll have to have higher recapitalization. So the RBI is so fixated about its monetary policy transmission that it's not thinking through the consequences of its action, apart of course from being a throwback to the bad old times of the 60s and 70s. Amol.
I agree. I mean, this is absolutely true. I mean, because right now we are only sort of concerned about lower interest rates not being passed on to consumers and investor and business persons. But what about when interest rates go up? Are we going to be? It has to be symmetrical, right? So then you'll be more concerned that suddenly rates are going up, and then everybody's going to cry. So I think some of this should be in the hands of the banks because they are best left to judge these things. And I think RBI has also been sluggish. We've not really reviewed global experiences here. And looking at how some of the global central banks operate here, there are already concerns. I mean, by forcing too much onto banking system and asking them to push rates. So we are seeing that in Germany. We are seeing that in all kinds of places where interest rates have gone down, and Draghi's, who I just mentioned, is being portrayed as a devil. So I think we have to be careful here. As you rightly said, I think banks should have a more leeway here. You shouldn't really push banks into sort of having a transparent benchmark is important, but I think we've moved too quickly there, and we've not really looked at the global experiences here.
As always in the Indian context, but I'm afraid it's time for us to almost wrap up this discussion because we're running out of time. But Ajit, I have to ask you one last question. This is that given the context in which the MPC met, were you surprised that there was no mention of the ongoing crisis in PMC Bank, necessitating the RBI to repeatedly send out assurances regarding the health of the financial system? Should there not have been some mention at least of it in the statement? Ajit?
Yeah, I guess so, because it's very relevant, very topical, very current, and there's been, the RBI actually issued statements right after the sort of freeze on PMC that depositors should be assured that don't listen to rumors and whispers and so on. So I guess but MPC's mandate, I guess, is different. Perhaps in the policy statement something could have come out. But the RBI has, by the way, issued a lot of statements after the PMC freeze. But it's true that the whole thing about cooperative banks under dual control, that's a big concern. So, and how much of it is really bad, how much of it is downturn in business. So it's important that but RBI should put out the statements rather than just depending on the MPC, I think.
Okay, Anant, let me just ask you for a quick word. Given what Ajit said and given what we are seeing, should financial stability be made an explicit part of the MPC's mandate so that the minutes will at least reflect what the MPC's views are on that? Very quickly, Anant.
Two very quick points. First, the governor has made it extremely clear that he's very, very focused on both growth as well as financial stability. So to that extent, while he's working within the flexible inflation mandate, I think he's already doing a fair job of keeping the overall context in mind. Second, in 2021, we'll have a review of the Monetary Policy Committee framework. I'm sure it will be an extremely heated review with a lot of viewpoints coming through. Personally, I'm not a fan of flexible inflation targeting in the Indian context. We don't even know where inflation is going to be with 46% in CPI in food and 57% in food and commodities. I don't think demand management works in the Indian context. You know my views on this one. But in 2021, in God's good time, we will have a nice debate around this.
Okay. Unfortunately, the problem in India is that we have too many debates and very little action. But thank you so much, Ajit, Amol and Anand, for joining me in this discussion and trying to dissect what is it about the Indian economy that has made the MPC revise its GDP estimates downwards so drastically. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.